I do think that the Federal Reserve independence is at most risk than it has been during our entire lifetimes. If you have any sort of big career and big pedigree on Wall Street, if you go on TV and say that you think the Fed should cut rates, suddenly you're in the running to be the next Fed chair. I support an independent review of the Federal Reserve, but I don't think that the Trump administration wants to stop quite there. I'm joined once again by my friend and business partner, Max Wethy. Max, welcome back to Monetary Matters.
Thanks for having me, Jack. I want to start with the big question, and that's the question about Fed independence. We just had a pretty interesting Fed meeting because it was the first meeting featuring Steve Mirren. I know that he's somebody that you've interviewed actually multiple times, and you consider him to be a friend. I know we're trying to get him back on sooner rather than later, but obviously there has been a lot of talk about whether the Fed is independent, whether it should be independent. This was a big Fed meeting for that, with Mirren being on the board of governors and casting a vote as an interim Fed governor. What do you think? Is the Fed independent?
That's a really good question, Max. I first want to give a shout out to our sponsor here today, Fiscal.ai. As our viewers know, Max, we talk all the time about stocks, bonds, and indices and macro, the Fed. But what you and I trade and invest in our individual investing is by the vast majority individual stocks and single stocks. And I know there are a lot of people who do that as well who are watching. And so if people are invested in single stocks, they need to do research. I mean, they're going to get crushed if they don't get to do research. And that is where Fiscal.ai comes in. It is the fastest growing single stock research platform in the world. And we have a 15% discount that is available with the link in the description. Getting back to your question, Max, I do think that the Federal Reserve independence is at most risk than it has been during our entire lifetimes. We could go back to when it was very independent, but it was the gold standard. So they actually weren't, they weren't beholden to a government; they were beholden to a standard. Then, with the abandonment of that standard for the U.S. in 1971, there were a lot of concern, and you had a huge inflationary uproar. So critics of central bank independence say this thing was invented in the late 1980s, early 1990s. It's not like, it's going back to ancient Rome and there's this huge tradition. And I think that is correct. But central bank independence was maybe a fiction, but it was created to protect price stability and to imbue these central bank institutions with authority and belief that central banks would be there to stop inflation. And I think that's a really, really important role. And, the price of gold is rallying as if central bank independence is already gone. I don't think that's the case at all. I think it's just because there's some certain Chinese financial institutions that are just buying as much gold as they can get their hands on. But I think Max, with Steve Barron, who, yes, you are correct. I do know him. He was confirmed as a governor of the Federal Reserve Board on Monday. And on Tuesday, the FOMC meeting began. And on Wednesday, it was reported that he cast his dissent. So his first few days in the office, I mean, Max, and I first joined the company of Real Vision. When I joined, I didn't, express a dissent. I was just doing what I was told. Okay, this is where the seltzer water is. These are where the staplers are. But yeah, Steve is taking a different tack, and he's already casting a dissent, indicating his favor for a 50 basis point cut. But he expresses a view that's very similar to the president who appointed him.
There's a lot of discussion about who will be the next Fed chair. Two people that potentially could have been in the running. Some people say they're not in the running anymore because they didn't follow Mirren into that dissent on 50 basis points. Waller and Bowman both called for 25 basis points in the prior meeting. They were in the dissent there. Unusual to have a lot of dissent in these meetings. So just, two people is quite uncommon to see. And then this time around, though, they voted with the majority, voted with consensus and called for 25 basis point cut. There's certainly been some commentary saying that, okay, well, they have failed their audition to become the next Fed chair. Do you think that's true?
I honestly don't have a strong view on it. I've heard other people talk about Zervos, who I believe is dating Kellyanne Conway, who used to work for Trump as a spokeswoman. And then also Rick Reeder, Rick Reeder, I remember seeing him, literally watching him interview on CNBC when he just expressed a very dovish take saying, yeah, the Fed should cut. And then immediately he's rumored to be the next Fed chair. So I guess if you have any sort of, big career and big pedigree on Wall Street, if you go on TV and say that you think the Fed should cut rates, suddenly you're in the running to be the next Fed chair, I guess.
I'm pulling up Kalshi right now. They have a betting market on who is going to be nominated as the next Fed chair. And Mirren actually on the week has dropped 2%. So he's at 16%. Zervos, who you mentioned, is at 10%. Kevin Warsh is at 18%. Waller, despite people saying, oh, he failed, is actually up to 22%, up 3 points on the week. The person who has made the biggest advances is actually Kevin Hassett, who is on the week up to 25%. That's an 11-point change.
Yeah, I've never really met Kevin Hassett. I've seen him interviewed, and he generally is a very big advocate of supply side economics, but I haven't really seen him express detailed views about monetary policy. But I have seen as well. I'm surprised that he's number one, but I knew he was up there. And then we can't forget about Kevin Warsh, who of course is good buddies with Scott Bessent via Stan Druckenmiller. Kevin Warsh, interestingly, was seen kind of during the Obama years as the Republican hard money guy who is opposing all of these quantitative easing and zero interest rates. I think President Trump, he's looking for someone who who's having very low interest rates and accommodative monetary policy. So it's interesting to see if some conservative aligned folks known for their stances in support of quote unquote hard money might just become easy money central bankers, just like the rest of us, Max.
But Jack, we didn't really get to the main meat of the question about Fed independence. This is just one signpost along the road to the Fed potentially losing its independence. We can quibble about whether that's a good thing or a bad thing, but I really tried to get into, like, are we moving into a world where the Fed is no longer independent?
Steve is kind of just one point. Really, the concerns come from about President Trump and his statements about the Federal Reserve. He has stated on the record, I've heard him say that I should have a say in where interest rates go. That is clearly at odds with central bank independence. So when you have, the most powerful person in our government and the world say that he thinks he should have a say in something that officially the Federal Reserve should only have a say on, and that the central bank should be independent from the government, that is a clear departure. So I think it is Trump versus the Fed loyalists who are going to try and stay independent. Like that is I don't want to call it a war, but it is an ongoing fight. And a more conspicuous aspect of that fight is with Trump trying to fire Governor Lisa Cook, with the FHA director Bill Pulte alleging that Lisa Cook did mortgage fraud, but really just writing that she was going to take out a loan for a property that she said was going to be your primary residence. Turned out it wasn't a primary residence. And then later, it was reported, I believe, by Bloomberg that Treasury Secretary Scott Bessent did something similar of indicating that this is for a primary residence. Now, according to the Bloomberg story, there are actually differences in the story. Scott Bessent was a very wealthy man, and he applied for two different mortgages on the same day with Bank of America, the same bank. So the bank probably knew about it. But the principle is kind of the same. I ultimately, Max, I'm not into hiring or firing government officials for, uh, you know, alleged improprieties that really aren't a big deal and something that I think a lot of people would do. I wouldn't try to do it myself, but I don't think it's that big of a deal. I think, and if President Trump was so concerned about lying about on this real estate stuff, why did he hire Scott Bessent? He had something similar. So I really think that is a attempt by the presidents and the administration to oust someone that they do not like, and then put in someone who's going to be on their team in cutting rates. So, I mean, Biden, for all his flaws and what we later learned about his health, he abided by central bank independence. So that was not a big issue. Now, interesting, you can make the allegation that Powell and the Federal Reserve were a little too dovish in 2021 to get reappointed.
Well, then perhaps the argument would be that there should be term limits, that nobody can be reappointed, right? That you're in once and then you're done. But again, then you're going to have people with no experience in the Federal Reserve System, right? Like if you can't move up, then you're just going to have new people coming in who are not familiar with the system. So I don't know if that's necessarily the best thing. And going to the allegations of mortgage fraud and that it is it's a political move. Like, I do think it's, like, extremely ironic when you think about the charges against Trump in New York State. to like very similar allegations, right? That he misrepresented the value of assets in order to get like larger loans. And the thing that a lot of the people who said this is obviously a political witch hunt for Trump pointed to is that all of the banks that did business with Trump were like, yeah, we got paid back. Like nobody was harmed. Like we don't really care about this. And so these would the argument from the supporters of President Trump were like, this is a completely non-issue. Like none of these banks care. He paid back the loans. It's not like he defaulted on these loans and the banks got stuck with these assets that weren't quite worth what he said that they were worth. And so, if you were to take that side and say this is a non-issue because there's nobody has been harmed here, as well, it's like extremely typical in the real estate world to, fudge a little bit on what things are worth so that you can get a bigger, better loan from the bank. And you could argue to what degree is that actually encouraged by the lenders? Like that is kind of the argument here on the other side. It's like it seems very apples to apples to me. And depending upon which side of the political aisle you sit on, you might say, well, this was obviously a political witch hunt. And then a similar thing happens and it's no, it's not a political witch hunt, or it is, depending upon which side you sit on. So I view both situations through the same lens. I didn't particularly like what happened in New York State and going after Trump. I think it was like extremely politically motivated. And I don't particularly like what's happening here. I think it's very similar. And I would prefer, as you said, that it not factor into the hiring and firing of people. I don't think it was particularly relevant to whether Trump, should have been elected. And it became a huge talking point in the election, that he was convicted of these crimes, that arguably should not have been on trial for. And I think a similar thing is happening here.
I share your views, Max, and the reason I'm running my mouth about this and not about Trump's as lawsuits against Trump for those real estate things is because I'm not a political reporter. I'm a Federal Reserve analyst, and that's kind of my wheelhouse. So that's why I'm talking about this. And yeah, I think it is something of a witch hunt, and I do support the Federal Reserve independence. And it seemed, I mean, look, until the spring of next year, the Federal Reserve does have a steady pair of hands in Jay Powell, and God, I mean, nothing phases him. He was asked about Steve Mirren. The reporters were just trying to start all of this beef, and he just said, "I have no comment. I have no comment." So I think that it's Federal Reserve independence is in jeopardy, but I think it will survive.
Yeah, I mean, I think Scott Bessent called for an independent review. People asked him about that, and he said, "I have no comments on what Bessent said." And they're like, "Well, let's just ask about an independent review." And he said, "Of course, we're always open to analysis of what we do and whether we could do it better." Like it was a very skilled and deft handling of those questions.
Yeah, and I'll say, I think actually in Ben Bernanke's book, he talked about how Ron Paul had this movement of audit the Fed, and Ben Bernanke was trapped in this view of like the Federal Reserve already is audited; it releases its financial statements. Like what Ron Paul wanted to do was basically end the Fed, and Ben Bernanke alleged that there was a Ron Paul quote where he basically said like, "Oh yeah, by audit the Fed, I mean end the Fed," and like I support an independent review of the Federal Reserve. Definitely, but I don't think that, the Trump administration wants to stop quite there.
Let's get into the market aspect of it. What was Fed Watch pricing as far as like future moves in interest rates? I think it was pretty much set in stone what was going to happen coming into this meeting. I'm more interested in looking out at future meetings. Did anything change in what we can expect going forward as a result of both the SEP and the statements by Chair Powell?
Before I get into that, Max, I just want to talk about Fiscal AI, today's sponsor. This is a great tool for tracking fundamental data on companies, not just the net income, the margins, the profits, the cash flows, but it's visualized in an excellent way. And you also have company specific data that are in the earnings releases that are not going to show up on your typical stock fundamentals tracker. I use it, Max uses it. It really is great for helping to understand stocks, finding stocks, really every stage of the research process. And they also have amazing visuals. So you can get a 15% discount off by clicking the link in the description. Max, tell us about Fiscal AI.
Yeah, I was gonna say one thing I think you're also should have added is the way that they use AI to update the data in real time. Like so many of the data providers out there, it's like an army of people in different countries around the world that are taking these PDFs as the companies release their earnings data and they're manually inputting it. And that means it takes time to actually get the data when earnings comes out. But as we all know, like the increase in fast money trading, whether that be from the pod shops, individual traders themselves all over are reacting extremely fast to this data. And so if you're not somebody who has built a system yourself to go and pull data from the companies that matter to you instantly when the earnings report comes out, you're going to be left waiting a while to get the updates on the quarterly numbers. And Fiscal is really at the cutting edge of using these new AI capabilities to pull that information from the PDFs and get the data updated so that you can update your models. Because as we know, when things get announced, the moves are bigger than ever and they're faster than ever in terms of reactions.
And that link to get 15% off is fiscal.ai/MM. Again, that's fiscal.ai/MM. MM standing for Monetary Matters. The most pressing monetary matters yesterday, Max, of course, at the Federal Reserve meeting, just the pricing going into the meeting, almost a virtual certainty of a 25 basis point cut. And I believe the actual, very, very minor chance was for the 50 basis point cut. Not a huge change in pricing, I have to say, Max. Going forward, looking at let's say January 2026, the odds of a of a 350 basis points cut being the top range were about 42%, and now they're 40.5%. If anything, they went up somewhat today. They went up somewhat during the meeting, and then today, actually, they went up a lot, I believe, because there was a jobless claims number that last week was really bad, that this week was a lot lower. So again, actually, some good jobs news today.
One thing we didn't get into was sort of the bifurcation between the rosy picture painted by the SEP in terms of GDP growth and the path for rates.
Right. So, Max, just to be clear, the statement was extremely dovish. They said that downside risks to employment have risen. I don't know how much more obvious that the Federal Reserve can make it. So the statement was dovish. The dot plots were dovish. For 2025, the dot plots are for projecting 3.6% instead of 3.9 in June. For 2026, they're projecting a 3.4 instead of a 3.6. So the dots extremely dovish. The statement extremely dovish. What was I found hawkish was the projections other than the federal funds projections. So the economic variable. So real GDP actually is projected to go slightly higher. If real GDP is higher, the economy can handle a little bit higher rates. Unemployment in 2025 is the same, but in 2026 and 2027, unemployment is projected to be 10 basis points lower than was projected in June. If the unemployment rate is going to be lower, the economy can kind of handle higher rates. PCE and core PCE inflation are set to be 20 basis points higher in 2026 than in the June projection. So if inflation is higher, the economy can handle higher rates, and indeed higher rates are warranted. So every single economic variable uh, indicated that interest rate expectations and rates should kind of be higher than they were in June. And yet, of course, the Fed funds projection were far lower in June. So dovish dots, but hawkish economic projections that you factor into the dots.
Some people would say, okay, this is the Fed ignoring the inflation side of their mandate. If you were to take a more favorable view, you would say, no, they're just overweighting the importance of employment. And I think it's important to drill down on the maximum employment and how that differs from the unemployment rate that you talked about as their projections were in the SEP.
Right. So the unemployment rate, which has barely budged higher, is from the household survey. What has, I believe, freaked the Federal Reserve out is the non-farm payrolls from the establishment survey. And Max, these numbers are not good. I'll just be honest. Like, we learned that in May there were 139,000 jobs added. That's great, right? That was revised down to 19,000. So 120,000 jobs we thought that existed just never existed at all. 147,000 jobs added in June. That's great, right? revised down to 14,000, then revised to negative 13,000. So it revised to a 13,000 job loss. So that's a loss of 160,000 just in the revisions. So you've had 280,000 negative revisions in the past 2 months. In April, you had a negative revision. In March, you had a negative 108,000 revision. February, negative 49. January, negative 32. Again, these are the revisions. The final numbers are actually for January, February, March, April, they were fine. But in May, June, it's starting to look like it's going to turn. This could be a false turn, Max. This could be we've had many false hints of the cracking labor market. Last year, it was when the Somme rule was allegedly triggered in the summer of last year. So I hope this is another false turn, but this doesn't look good. But Max, the eye of the storm of this turn is in the non-farm payrolls, which is not in the SEP. The SEP only forecasts the unemployment rate.
Well, if we're getting all these revisions down, how come it doesn't show up in the unemployment rate? How could you have non-farm payrolls going down and the unemployment rate stay flat or even improve?
The short answer is because the unemployment rate is not revised. And so even though we've had an extremely good non-farm payrolls since 2021 and weaker employment levels, which are ultimately feed into the unemployment level. That's from the household survey. And so non-farm payrolls that were so good were somewhat revised down, and the employment level, they actually were not revised up. It's just that in January they just started to be really high. So you had a huge jump in the employment level that if it was non-farm payrolls, they would have revised the previous data up, but in this time, they just say it's a jump. So they don't revise employment data. That's why.
Okay. Well, I want to change directions here a little bit, and I want to talk about the stock market. It has been small cap season. I think obviously the last time we got together, we talked about the hyperscalers. We talked about the big AI companies, and certainly they have been the leaders of this bull market. But also one of the key aspects of this bull market has been the catch up by the rest of the market after they tend to lead things higher. That's what we have seen over the last month. I don't have the exact numbers in front of me, but I think it's an 8% total return from IWM as compared to a little bit over 3 from the Qs and from SPY. So you've had 6% approximately outperformance from small caps over this last month. A big move today in the small cap indices as people have finally had time to digest what just came out of the Federal Reserve. Is small cap summer going to turn into small cap fall, Jack?
So small caps, of course, that's the Russell 2000, the IWM. Max, I'm old enough to remember back in 2021 when it was large caps that low interest rates were good for because of the discount rate. And if you have lower interest rates, then Tesla and Nvidia, all these companies that are growth stocks, their earnings are going to be worth more in the future if interest rates are lower. Now, of course, the narrative has changed and it's all about economic survival, and interest rates being low is good for the much more indebted small cap stocks. I think that's both of those narratives are kind of true, but yeah, definitely now it is interest rates going down is good for small caps. I definitely think, yeah, like, Nvidia and Apple, they don't really care about where interest rates are going to be in terms of their business. Now, theoretically, Aslat Zamotarin, the valuation gurus would say that it does matter a lot because of discounted cash flow and the discount rate. And I'm a value guy. I believe in that. But in terms of the actual business, it doesn't really matter at all. So yes, I guess lower interest rates is going to be good for small caps. The issue, Max, I love small caps. The issue is that I invest in a lot of small caps. The issue is that so many of the small caps in like the Russell 2000 are junked, and they're just crappy companies that IPO'd and, they existed for 20 years. And if they were good companies, they would have graduated to the mid cap or even the S&P 500. So I think there are a lot of losers in the Russell. That being said, there's always a season for a certain asset class.
I think it also speaks to the importance of doing your homework and doing your own research in small caps. We've all heard about how like over half of the Russell 2000 is unprofitable, right? So there are all of these companies in there that are bad companies, or they're companies that are going through hard times. And if you actually adjust for the whether they're profitable or other aspects of quality that small caps do still have that feature of outperformance, but it speaks to why you need to do more research, right? And whether it's a 20-year-old company like you talked about that is actually doing something to change its business, whether the market has changed, for their products and services, or they're making changes in the way they operate their business, changes in management, whatever it might be, or it's just a new company, right? So, we have a few stocks we want to get in today. And I think the first one I want to start with, it's not necessarily a brand new company, but it's new to the US market, right? We had a report come out from our friend, Citrini Research. They do lots of thematic research, and occasionally in the course of that thematic research, they come across an individual name that they decide to do a deep dive on. And they did a deep dive on this company. The ticker is TIC. I think it's Acuren is the name of the company. Um, and this was a SPAC, a UK SPAC that recently came over to I believe it's a NYSE listing. So it's not a stock that has just been languishing around doing nothing for the last 20 years in the Russell 2000. So what did we get out of that research report? And let's get into some of the numbers from our partners at Fiscal.
So, Max, they are, as Citrini notes, the second largest provider of non-destructive testing, which they do for industrial facilities, power plants, pipelines, refineries, and transportation infrastructure. Again, I am the further thing from an expert in this company. I saw Citrini's report in this morning, and they also, Max, did a merger with NV5, which does infrastructure support, geospatial technology, and then buildings and technology. And it is that latter sector, buildings and technology, that's focused on data center. So, I mean, Citrini, there's no doubt about it. He's had a very hot hand on all of these AI stocks, not just NVIDIA, but Celestica, Coherent, Credo, which I actually got involved in more recently, Teradyne, uh, Vertiv, Eaton. I mean, the list goes on. He's got a hot hand. I mean, look, I think Max, in a bull market, kind of everyone has a hot hand. You have a hot hand. I have a hot hand. But Citrini, his hand is one of the hottest in this bull market, and particularly in this AI bull market. So shout out to him. But it's a data center a client, and basically they don't supply the parts for the data center. They allow that they make data centers run.
They make sure they stay running. So if people are
Yeah.
putting all of this CapEx into these assets that, one, they do depreciate over time, but if you're trying to get the most out of these assets, you wanna make sure that all of that infrastructure that you are investing, all the huge numbers that we're talking about, that it's not a waste. These things aren't gonna break down, and your customers, who at the end are gonna be paying lots and lots of money for the compute that these data centers are able to facilitate, that they're not waking up one day and saying, "Hey, how come our models aren't working anymore?"
Citrini,
Yeah.
he's got a hot hand, but you don't just, by the stock, because Citrini said, you got to do your own research. So let's see, you go to Fiscal.ai. We can show on a chart that basically the valuation is lower than its peers on a trailing basis. I don't believe it is particularly profitable, but on a forward EV to EBITDA multiple, it's 8.5, as opposed to the competitors that Citrini listed, SGSN and ITRK and ULS. So it is cheaper. And I think that if you have a stock that has all these catalysts and it has a low valuation, that starts to be compelling. And I was public on this program that the last time Citrini did have a call, it actually wasn't a single stock pitch, but he profiled. So actually, I think he's gone next level on this on TIC over Teradyne. It was Teradyne, and so I was public that I bought some calls in Teradyne, and it has worked out well. I use Fiscal to validate that thesis, and I'm looking at TIC now, Max. I found out about this company today, so the furthest thing I want to make it sound like is I'm saying I'm an expert. I'm of course not, but the bottom line is, as Citrini writes, he says NV5 is now working with every major hyperscaler to implement high efficiency cooling and power distribution systems in both new and retrofitted facilities in both North America and Asia. I know when Citrini, it's rare that he feels strong enough to write about a single stock like this. Normally, he talks about themes and baskets, obviously, which have single stocks, but not highlight a particular stock. So when Citrini talks about these kind of stocks, I pay attention, because historically he's done it on American Superconductor, and other companies, and it has been a quite interesting story to watch. And Coherent and Sienna.
Yeah, and I think, you talked about Teradyne, which was very interesting given, the day that they put out the report, which was, in connection with Hunterbrook. Um the stock was up, I believe, 5, 6%. That day, also Goldman Sachs downgraded. And so it's kind of speaking to a change in the guard of who is the market listening to. Are they listening to the old guard of sell side research, or are they listening more to like the independent research companies? And just to give you an idea, this isn't like it's not a huge company, but the market cap intraday reached 2.698 billion. It was a $10 stock coming into the day, and the average volume is 2.3 million shares. So, it's trading $20 million a day. It's not a nothing stock. It's not a huge stock in the grand scheme of things, but it's trading 20 million a day. Today it traded 21.8 million shares and was up 22.94%. So clearly the market is paying attention to what is coming out of non-traditional, financial research and independent research producers like Citrini. So if you are somebody that is only looking at the estimates of the sell side, um, you are probably going to miss out on what a lot of other people in the market are paying attention to.
And it's funny, Max, on TV, sometimes they say like, Wells Fargo just upgrade. And it's like, do people really care about that? I mean, maybe some people do, but I don't think that those effects have what they used to. I mean, if you read books about like the 2000, these sell side analysts were like gods, and they'd get to meet with Enron and they'd say, Enron still a buy. And it'd be, we're not in that world anymore. It's the Trini's world.
Yep. Well, speaking of financial data, I know that there were another group of companies that you wanted to take a look at. Let's talk about MSCI.
So they are an index provider. So you can look at their revenues from index operations, and then from analytics, sustainability and climate, and then all other. So interestingly, this to me, so index provider, this is the, BlackRock will create an ETF based on the MSCI world. Like it's an extremely good business because it have very, very little variable cost. And as the financial world gets bigger, their profits just go up too. In the orange bar, we've got the analytics business. This to me, Max, reminded me of kind of Moody's, where Moody's has the MIS, Moody's Investor Service, and then the Moody's Analytics. I interviewed the chief economist of Moody's Analytics earlier this year, and Moody's Analytics is kind of like a more traditional economic consulting business where they help people out. So it's not as high margin, and then sustainability and climate. Huge bull market in like 2020 and 2021 of ESG. That market's cooled down a little bit, but honestly not as much as I thought. And then interestingly, I'll just choose this. Like the private market really is growing. And if you look up Morningstar, they also own PitchBook. Like actually, I'll just do that right now. Why not? Morningstar, they own PitchBook, which really is a huge business. And so they have this PitchBook revenue, and then they had a reorg, so they pitch us. But like if you look at the blue and the red together, this PitchBook is really growing, and this is all of the data on private companies, venture capital, but particularly private equity. And I think that this is a very good asset. I mean, if PitchBook was a publicly traded security, it would probably have a PE of 45, but if it had a PE of 20, I would be buying that all day long. So for full disclosure, I do not own Morningstar or MSCI.
Let's talk about a name that you do own, Franco Nevada. So gold has absolutely been trading up, and I know that one of your favorite ways to play gold, going back to when the founder Pierre Lassonde was interviewed on Real Vision by Kirill Sokolov from 13D Research, has been Franco Nevada and that royalty model. For those of you who don't understand the royalty model, gold mines, obviously, they're betting on, what's underground. They don't have revenue, makes it very difficult to service debt in the form of a loan. So a lot of times what they'll do, because they can't tap the capital markets in the same way companies that have actual revenues do, is they will sell royalties to companies like Franco Nevada and say, look, you'll get 2%. Everything we ever pull out of the ground and sell, you will get 2% of that.
In exchange for $80 million. So these gold royalty companies, they have high capital expenditures up front, but then once they've built that, it's extremely cheap. And like Murray Stahl of Horizon Kinetics, has wrote about the value of these companies that even if they trade at a PE of 50, the capital that they have to put out in order to get that PE is it's locked in. It's kind of locked in the cake. So it's not bond like, but it is way more bond like than like a steel mill. It basically is like, oh, I get 2% of every single piece of steel that's made in the steel factory, and I have to spend almost next to zero capital on an operating basis. On a capex basis, you have to spend a lot. So these companies typically have extremely high uh, n- operating profit margins or extremely high gross margins, typically about 90%. And then their operating margins for Franco Nevada is around 70%. And a lot of the real cost is depreciation and amortization, which comes out of um the income line. So I'll just show this on screen. So that's the depreciation. So let's see. We've got revenue, depreciation, and then operating income. So like uh in you'll see that uh the blue is the revenue, the operating income is orange, and the depreciation is the fittingly gold bar. Ignore 2023. They just reported a huge loss because they invested a ton of money in this mine in Panama called Cobre Panama. That because there was an election and that mine was ruled illegal because the people voted against the mine. Interestingly, the price of gold is going up, and they are kind of saying, "Hey, the people of Panama are saying, hey, maybe we should reopen this mine." That would be very good for Franco Nevada. Full disclosure, I did sell a decent chunk of my position at around the $200 mark. Acquired, roughly in the, mid 160 range. But I'm not bearish on the stock, but yeah, but they recognize an asset impairment. So they didn't really, it wasn't a huge cash outflow. It's just that they recognized an impairment of this Cobra Panama. I believe it is marked at zero. So this is the income statement. Going to the cash flow statement. And Max, this is, I guess, not technically part of my job for our business together, but I do this like many times a week. Sometimes every day. But their cash from operations is always very, very high. The price of gold is gone. This is in dollars, so the price of gold going up is obviously very good. Um, then their capital expenditure is also quite high. They've done some high profile deals out here. If I were to go on an annual basis, I'm going to guess that in 2015, 2016, that's when it would be high because that's when they got into these like deals. Yeah, so 2015 and 2016, these deals are high. So really they don't have to spend any money at all. They keep on just reinvesting in the business, but a lot of these mines can last for 10, 20, 30 years. There actually is a royalty company I own a, very, very small stake in. Not gold, they have gold royalties, but it's oh, what is it? It's like phosphate. It's some type of royalties they technically like have a 90-year life. So just imagine how valuable like having a royalty for something that's going to last 90 years. I'm not saying that anything Franco Nevada is doing is going to last 90 years, but it's an interesting way to think about it. Another version of playing this is Texas Pacific Land Trust. That's completely oil. Franco Nevada, actually, it's gold and silver, but also oil and some PGM, precious it's a platinum group minerals as well. They have some copper royalties as well. Their gold equivalent ounces has been rising. Excuse me, other than ex Panama. So there was a big downgrade. So this is why the stock suffered from a while because uh it went from 403 gold equivalent to 290,000. So this cover in Panama was a big hit. But the earnings, I mean, gold has just gone up so much that this has gone by well. And then also interesting, you look at silver, silver gold equivalent ounces. It looks like there's just been an utter collapse in the amount of silver sold, but actually it's just that the silver relative to the price of gold has gone down. So like in um, March of 2021, I think silver was like peaked at $30 relative to gold. Like silver up until recently was a lot lower. Like for the past few years, silver's been in the 20s. Now silver's in the 40s. And interestingly, I've only like looked this up very, very tangentially, but I think silver actually could have a use case in AI, which would be very, very bullish. The other name, which I do not own, is Wheaton Precious Metals. They have a closer to a 50-50 split of silver and gold, like probably like 40% gold, 40% silver. And then also, Max, I'm just thinking about uh, just these gold royalty companies about the size. I think that the smaller gold royalty companies, you have to do your work. Like there's another stock I still own, EMX. that actually is going to be acquired by another one that I don't like nearly as much. But I think that actually the bigger ones actually could be good because now is not a time to do gold royalty deals. Why? Because if you're a miner, you don't need this extra capital. But it's very good to have owned gold royalty deals that you've done over the past 10 years. So like Wheaton Precious Metals and Franco Nevada in particular have done work on Franco Nevada. They have like all of these deals that they've done that aren't yet producing that could go online. So it's just interesting business model. And I urge people to do research. And if where else to do research other than fiscal.ai/MF, right, Max?
So, Jack, I want to take a look at some other companies here with Fiscal. Two companies that actually some of our clients. So, full disclosure, these stocks are owned by clients of ours and our hedge fund consulting business. Um, and these two stocks have both done really well. They're in some of the hottest sectors right now. Obviously, aerospace and defense, with everything that's been happening in the world, has done very, very well this year. As has anything connected to AI. So Nebius Group is one that they just got a deal with Microsoft, and basically it was an $18 billion deal. They're in the data center business, and that sent the stock up. I think it was up over like 60% after hours. I don't know where it has settled down in this past week or so. Usually when you get those big announcements, like I think we saw with Oracle, it rockets up and then it finds its ground. They haven't really given back too much of that, but that has been very interesting. I don't think we have segments and KPIs for them. But another stock that our client owns is FTAI. FTI was a very interesting stock because it's kind of the battleground. Another friend of the pod, the folks over at Muddy Waters, put out a short report on this company because they have a leasing business. And I think obviously whenever you're dealing with leasing, you can get into some complex accounting stuff. That's really what the folks over at Muddy Waters, one of their specialties is looking at, potential impropriety when it comes to financial statements and accounting. So I am not going to really jump in and make any arguments for or against what they have said, but you can kind of look at their leasing business versus some of their other business.
So in dark blue, we've got the aviation leasing business, and he's not showing much growth since 2023, to be honest. But then in aerospace products revenue in orange, you have a huge, huge growth. And I did not read in full, but I think the Muddy Waters report was saying was that a lot of what they call MRO, maintenance, repair, and something in for FTAI was actually just kind of more vanilla leasing. So they had a convincing report. I mean, Muddy Waters did a great job. It's definitely some of the best shorters out there right now. Definitely, the best activist short seller for no doubt. But it looks as if our clients at Crossroads in the longer term have been right about this name. I know that I actually did some. I have not looked into this name, but uh, into FTAI. I've looked more into the kind of the king of the aircraft leasing game, AirCap Holdings. They have like 3,000 planes and engines and helicopters and everything. And, it's kind of a commodity business, but they do it quite well. But FCAI, I know they kind of have a more special sauce, more in maintenance and repair. And clearly, as the revenues, the revenues don't lie.
Sometimes, and I'm not making any accusations here, but I think that is what the argument would be at
Yeah,
Muddy Waters.
sometimes revenues
Sometimes
lie.
they do.
Yeah,
Sometimes
yeah.
they do. So, just those battleground stocks are always fun like that. And yeah, our clients at Crossroads, they do put out research sometimes on individual names. So anybody who wants to get up to speed on Nebius or FTAI, you can do so on Fiscal, but I would also recommend going to crossroadscapital.io, and in their insights section, you can find write-ups on FTAI and on Nebius. The Nebius one is actually one of my favorite titled pieces that they've done because it was actually a Russian company at one point, and so it's from Russia with cash because at the time that they invested in it, there was a ton of cash. Obviously, so much has happened in the AI world. I think that initial report was written back in December, so the stock is up so much that the margin of safety provided by the cash they have is maybe not quite the same as it was back in that valuation. So make sure to go to Fiscal and check on where that cash level is relative to the valuation after you read the report from Crossroads.
Absolutely, Max. And talk about activist short sellers. There was an activist short report. I read some of it from Carisdale about CoreWeave, and CoreWeave is what Semi Analysis Dylan Patel has called a neo cloud giant, where basically they get a bunch of GPUs together and then they sell those clusters to hyperscalers. I think so. CoreWeave is in that business. Nebius is in that business. Other ones, Lambda and Crusoe. I don't believe those are publicly traded, but CoreWeave had an IPO recently, and Nebius obviously is as well. So that is, I mean, I think that's kind of further out on the risk spectrum than say a Microsoft or an Nvidia. But clearly, those are going well. And Max, I'm actually kind of glad that we started covering this issue about 2 months ago. But like all of this growth is related to AI and capex. Like I feel like a lot of economic stories are negative, and the positive ones, in 2022, so many positive stories. Even though there was all this recession fear, it was like the consumer is growing at 9% year over year. Like now you're not really seeing that. Like all of this huge growth is within an extremely specialized sector of computers, technology, but in particular, artificial intelligence and data center build out. So I think that the economy is vulnerable to if this thing slows down. I think definitely there could be a slowdown and maybe even a recession. All right, we'll leave it there. Follow me on Twitter at JackFarley96. Follow Max at Max Wheaty and his podcast OPM Pod. And don't forget to check out today's sponsor, Fiscal.ai at Fiscal.ai/MM. Until next time.
Thank you. Just close the door.